All right, so we have talked about the strategy, the how and the why, and I've introduced the spreadsheet as well as my favorite stocks to use for it. So, what are we going to talk about at this point? Well, we need to talk a little bit about the trend and why the trend is important and which directional strategy you should use. But again, we are going to go over this in a little bit more detail later on in the presentation, but we're going to brush over it right now. So, let's talk about the trend, identifying upside, downside, or chop. When you're talking about a trend direction, remember that you have to remember that I was doing this when I didn't know any technical analysis rules. I didn't know fib. I didn't know anything like that. It was really just a basic eyeball. Now, of course, if you're more advanced than that, yes, absolutely use that to hone it, but you don't really need it. So, when we're looking at the trend, here are the main factors right here that I use to quantify it. If you're in an uptrend, you're looking for an obvious upwards trend with nice, steady pullbacks. The one main factor that will tell me it's not a steady trend is when you have like an upwards movement like this and then a huge jerk lower and then, a little grind, and then that's not an upwards trend. What you want is a nice, steady stair-step pattern higher. Sometimes there are going to be moments of a market sell-off. So for example, going into May 2019, we had a really nice market. The S&P dipped and then rallied to brand new highs. So yes, you had a dip right here. But on uptrending stocks like the Phoenix, they will fall with the market and then they will rally ferociously. But I'm not looking for something that, for example, is rallying, gets destroyed, falls below the 200 period simple, and can't recover. That is not an uptrend. So that's one easy rule that you can use to kind of narrow those down. But overall, what you're looking for is you're looking for nice steady pullbacks, clean moving averages. What that means is when you have your moving averages on your chart, they're nice and steady, and you might have a portion where they cross right there, but they're nice, steady upward movements. We're not looking for this, okay? That's not helpful for an uptrend. With a downtrend, it's going to be the exact same thing. You're looking for steady downwards movement. Downtrends are a little bit more difficult because they don't usually ebb and flow in the cleanest type of fashion, but you definitely don't want moments where they rally ferociously either. So you want a nice, clean downtrend with moving averages stacked if you can get them, which would be something like this. And then clear respects of resistance. So that would quantify or qualify a downtrend. And then as far as choppy goes, there's a difference between like spastic and choppy. So for example, if you're looking at something that's choppy, you can look at anything that has a weekly squeeze, because a lot of these tickers that have weekly squeezes right now, for example, Salesforce or Etsy, and again, this is being made in July of 2019, so you can go and compare that. We can look at it in a minute. But these are examples of something that is choppy. And the reason why they're choppy is because they have consolidation on a weekly chart. And so it's kind of like a tight range, but movement back and forth like that. But it's not violent, crazy, movement like that. That's just not really helpful. If you're never really sure, look at any of the biotech stocks. Those ones don't have any sort of trend whatsoever. Anyways, the moral of the story is there's a couple different ways to find standard deviations. You can use the Analyze tab, you can use a spreadsheet, or you can use a combination of both. So we're going to go over the Analyze tab in a little bit here, but I did want to start off with the spreadsheet. I don't really use the Analyze tab a whole lot in my trading, but you are able to use the Analyze tab to display standard deviations, so I am going to show that to you. The core piece of this is going to be the spreadsheet that was made specifically for this class. And what this does is it enables you to pop in a stock price, and it will give you all the exact levels that you can use. The piece right here that's important is that you can use any of these options. or you can combine them, just whatever works best for you. Now, when I go back and I say, okay, well, let's talk about your choices. What should you use? Should you use a call credit spread? Should you use an iron condor? Should you use put credit spread? This goes back to eyeballing the trend, and it also goes back to what your experience level is. So we're going to go over a bunch of examples right here, and I'm going to show you how to do it in the spreadsheet. But the moral of the story is that when you're selling a call credit spread, the entire goal here is that you don't think it's going higher than a certain level. So it's better if you do that on a downward trending stock or a sideways stock. If you want to sell an iron condor, that means you don't care which direction it moves, but you don't think the stock will exceed the standard deviation move to the upside or the downside. So essentially, the best time to do this is when the stock is trading sideways. The next piece of this is selling put credit spreads. This is the one that I do the most often. Why? Because we've been in a bullish market for 10 years or more. So this is the easiest thing to do, especially on strong trending stocks. You can focus on the upside, and then you just sell put credit spreads, sell put credit spreads, sell, sell, sell as the stock trades higher. So let's go over and flip over to our example tab. So one of my favorite tickers to use this strategy on is Amazon. So let's flip over to Amazon, and I do want to point out, like I explained in the beginning of the class, that you do not want to do this strategy directly before an earnings report. So keep in mind that this is literally for example purposes only, and we would never sell premium at a 1 standard deviation before an earnings report on Amazon. We would not do that, okay? But because of the day that I'm recording this class, it happens to be directly before Amazon's earnings report. I'm still going to walk through the entire process, okay? So why do I like Amazon? Amazon is a high price stock. It's currently trading at $19.85. It also has a pretty nice uptrend. You can obviously see there's a time period in here. This was the downfall that we saw in the market throughout the fall of 2018, and pretty much everything looked like that during that time frame. Now you can still use this strategy during something like that. You just want to switch your direction when the switch is made, and then you would be selling call credit spreads instead of put credit spreads until the switch happens again. So at this point, we're in a bullish uptrend since about December, right about in here. Let's see when that was. So when it crossed through the 50 period simple, that's the switch. So that's when the switch happens. At that point, when the price comes and closes above the 50, you now have to look at it to the upside. So that is your qualifier. Okay, so you're in an uptrend. You're looking at the different ranges that Amazon has. And right now, it's currently trading at $19.85. So what you do is you're going to come in here to your trade tab, and you want to look at the different options that you have. Today, as I'm recording this class, is on a Monday, so it's a perfect time to look at this. And what you can do is you can look at either one of these series right here, 11 days till expiration or 18 days till expiration. The way that I usually do this is 11 days till expiration, and I note the implied volatility. So you can see the implied volatility right here is going to be 34.86%. So here is your handy dandy spreadsheet. Okay, let's make this a little bigger. There we go. All right, so you don't really need to type in the ticker, but it's helpful. So looking at Amazon, you say, okay, what's the price? $19.85. Great. And then you're going to move on, and you're going to look at the implied volatility. Let's see if we type all of this in, if this is going to populate. 34%. Maybe I typed that wrong. Okay, I had to pause that for a second and figure this out, but so it's really ridiculous, actually. So I'm glad that I did that so that you could see what the problem is here. So I just had these columns just a little bit too tight, and you see how When the columns are too tight, it populates into this type of whatever symbol that is, and then you can't get the actual calculations. So I don't know why that happened for this section when I was trying to do that, but you see that's what the problem was. So I'm just going to pick up where I left off. Like I was saying, what you want to do is you want to start with your stock price. Looking at it right here, and now you can see that Amazon is trading at $19.85, and then you want to come over to your options chain. And like I was saying before, you don't want to do it in the earnings series, but this is for demonstration purposes. Looking at the August 2nd series, it's going to be about 10 days out. It's going to give you an implied volatility of about 36%. So you come back into here, just like that. And what that's going to do is going to give you the projected areas. You also can look at your calendar and see, okay, well, what is the expiration date? The expiration date is actually going to be August 2nd. All right, and now for me, I typically like using $5 wide strikes, so I would change that personally. And then you just want to make sure your days till expiration is accurate, so you count today. So it's 1, 2, 3, 4, 5, 6, 7, 8, 9 days till expiration. Okay. So now what that gives you is it gives you these overall levels. So you have one standard deviation move, which is about $112, 1.5 standard deviations, which is $168, and 2 standard deviations, which is $224. Now, what I used to do is I would just add it to the upside. So for example, if you have 1985, then you would add on 1 standard deviation to the upside, which would be 112. But the thing is, you don't need to do all of that because that is all calculated right here for you. So if you take 1 standard deviation and add it on to this price right here, that is the price that you're getting. So that would be the upper call credit spread, which is coming in right here. The next piece of that, 1.5 standard deviations, that is going to give you a price of $21.53. And that's going to be your 1.5 standard deviation. In your second one right here, $224 is 2 standard deviations. That would bring you all the way up to $2,209. So and obviously, it's the same on the downside too. So those are your 3 downside standard deviations. Now, depending on your personality, what type of trader you are, it doesn't really, you can do it both ways if you want. I know there's a lot of people who are completely comfortable with selling out of the money premium on a strong stock like Amazon to the upside. For me, I prefer doing the downside just because I feel like if it's going to go parabolic, it's more likely it'll go parabolic to the upside, but that also depends on the overall market condition. So the next thing that you need to do is take a screenshot of this because you want to, and I guess in my screenshot I can make this a little bit smaller so it'll all fit on one screen. Just wanted to make sure that you could see it. So then what you want to do is you want to take a screenshot of it. I have this program that I use. It's called Snagit, and I can take pictures of basically whatever's on my screens. Take a picture just like that. And then what you do is you want to save your screenshot and you want to put it into your trading journal, because what this is going to help you do is that if you track this week over week, and let's say you come in here and you take a picture and then you save it. You want to do Amazon spreadsheet, and this is the updated one, so I'm going to save it as V2. And then what you do is you are going to throw that into your trading journal, and then you'll get kind of a feel for how Amazon moves. Now, the next piece of that is you're going to come into your options chain, and then you're going to actually look at the strike prices and see what options you have. So I'm going to start with the downside, which is going to be right here. So depending on, what type of risk reward you want, and depending on what type of market it is, you're going to get the best amount of money out of it if you just do the one standard deviation, but it's also going to be more likely that you're going to have to close out your trade if the market comes near it. So you just have to decide, what is more important to you? Would you rather have less money, or would you rather have less money, or would you rather have it less probability it's going to be closed out? So for example, if I do it at 1872, now you notice in the number here it's 1872.79. Well, we don't have that exact number, right? But that's fine. You can just go kind of around that area. It's just kind of a gauge. And it's good if you do the round numbers instead of the half strikes, just because those typically have more volume in the strikes. You can look over and you can see the other people that are doing this, because you have 140 contracts there. You have 211 contracts there. So, we're not alone. Amazon is a good one to do this on. And if you go down here and you say, okay, well, I'm going to do the 1870. So you're going to right click on it. Whoops. Okay, so you're going to right click, sell vertical. Now, I never sell them naked personally. I'm not a fan of that because I don't want to be assigned. So whenever I do something like this, I'm always going to do it with a spread. So you can go back and forth between a $2.50 wide spread or $5 wide spread. And what you're doing is you're just looking at your credit. So and I'm just going to show you with one contract, so it's easy math. But 1870 to 1865, 37 cents. And then what you're doing is you're looking at, okay, well, what's your max profit? What's your max loss? Now, obviously, you're going to have much more of your risk reward is that you're more likely to lose more when you're wrong. So you have to kind of widen this and say, okay, well, would you rather have it $5 wide? Would you rather have it $2.50 wide? And if you look at something like this, you have a max loss of $432 and a max profit of $77, but the likelihood that it's never going to touch this strike is like 70%. So that is the type of situation that you're looking at. The other thing that you can do is you can come up a little bit tighter. So if this is one standard deviation, that's going to be $112. If you cut that in half, and if you say, okay, well, I'm going to come in a little bit closer, and instead of doing it at $112 away from the actual strike price, let me just do it $60 away from the strike price. Now, that is going to come in much, much higher, and the probability that you're going to have to close it out is going to be a lot higher, but your credit is going to be better. So if you say, okay, well, just in case, let me do it 1950. So you see how you went from getting about a 77 cent credit to getting $1.42 credit. So now at this point, you're risking $355 per contract to make $145 per contract. So for me, I personally like that a little bit better, but you have to remember that you just cut your probability. So if you had about 68%, 68.9, whatever it is, 70% probability that it was not going to touch 1870, well, if you cut that in half and you say, well, I didn't really like the credit on there, so what I'm actually going to do is I'm going to cut the standard deviation in half, and I'm going to look at a 60-point move, which would take me to 1920. Then you still have 45% probability about that it's going to be out of the money. And for holding something like that for a couple days on a directional trend follow for a better risk reward, I honestly like that better personally. But I know there's also a lot of people who like selling premium that's that far out of the money that they know that they most likely don't have to worry about it. So it just kind of depends what you're trying to do. Now, like I talk about later on in the segment, the best thing for me to do is the 5-star strategy. So what that would be, the adjustment on that is instead of selling 1 standard deviation, instead of selling a half standard deviation, what I do is I come down and I wait till the price hits the 21 or the 34 EMA. And then instead of selling it out of the money, which, I mean, you still can for sure, and that would give your trade an even higher probability that it's going to work, is what you can do is just sell it at the money instead. So you want to go down a little bit more time if you're doing it at the money. So I would add another week on there. But if you look at this instead and you say, okay, well, I'm actually going to do 1980. 1975. So now you have a 1-to-1 risk reward scenario. So those are basically the 3 ways to slice it up here, the 3 different options that you have. Like anything, it's just about your trading plan and what you want to do with it. Okay? So I'm going to move on to the next section and I'll see you in the next video.